The average directional index, or ADX, is a technical indicator used in technical analysis to gauge the strength of a trend in a financial market. Developed by Wells Wilder, the ADX is a versatile tool that helps traders identify strong trends and potential trading opportunities. Unlike many other indicators that focus on price direction, the ADX is unique because it only measures the strength or weakness of a trend, regardless of whether it's moving upwards or downwards. Imagine a car driving down the road. The ADX is like the speedometer of the car, telling you how fast it's going. It doesn't matter if the car is going forwards or backwards, the speedometer only tells you the speed. Similarly, the ADX tells you how strong the trend is, regardless of its direction. The ADX is typically displayed as a line that fluctuates between 0 and 100. Higher values generally indicate a stronger trend, while lower values suggest a weaker or ranging market. By understanding the readings of the ADX, traders can make more informed decisions about entering and exiting trades. This indicator is particularly helpful for traders who are looking to ride strong trends and avoid getting caught in sideways or choppy markets. It provides valuable insights into the underlying momentum of the market, allowing traders to adapt their strategies accordingly. The ADX indicator is not a single line but rather a combination of three distinct lines that work together to provide a comprehensive view of trend strength. The ADX line itself, the plus directional indicator, or plus DI, and the minus directional indicator, or DI. The plus DI, represented by a green line, measures the strength of upward price movement. It quantifies the buying pressure in the market. The DI, represented by a red line, measures the strength of downward price movement, reflecting the selling pressure. By comparing the plus DI and DI, traders can get a sense of which direction the market is leaning towards. Lastly, the ADX line, typically displayed as a thick black line, takes the difference between the plus DI and DI and smooths it out over a period of time, usually 14 periods. The higher the ADX line, the stronger the trend. Conversely, a lower ADX line indicates a weaker trend or a period of consolidation. Think of it like a tug-of-war between bulls and bears. The plus DI represents the strength of the bulls pulling the rope, while the DI represents the strength of the bears. The ADX line acts as the judge, determining which team is winning based on the intensity of the pull. Interpreting ADX values is crucial for understanding the strength of the prevailing trend. While the ADX oscillates between 0 and 100, certain thresholds help traders identify strong and weak trends. Generally, an ADX reading above 25 is considered indicative of a strong trend. This suggests that the market is experiencing significant momentum in one direction. As the ADX moves higher above 25, the trend is considered even stronger, potentially signaling an opportunity to ride the momentum. Conversely, an ADX reading below 25 suggests a weaker trend or a period of consolidation. Values below 20 often indicate a ranging market where prices are moving sideways without a clear direction. In such scenarios, trend-based trading strategies might not be as effective. It's important to note that ADX interpretations should not be made in isolation. Traders often consider the ADX in conjunction with the plus DI and DI lines to confirm the direction of the trend. For instance, an ADX above 25 with the plus DI above the DI suggests a strong uptrend. The ADX is a versatile indicator that can be incorporated into various trading strategies. One common approach is using the ADX to confirm trends identified through other indicators or price action analysis. For example, if a trader identifies an uptrend based on chart patterns, they can use the ADX to gauge the strength of that trend. An ADX above 25 would add further conviction to the bullish outlook. Another way to use the ADX is through divergence trading. Divergence occurs when the price of an asset makes a new high or low, but the ADX fails to confirm the move. For example, if the price makes a new high, but the ADX makes a lower high, it could signal a weakening trend and a potential reversal. Furthermore, the ADX can be combined with other indicators to generate trading signals. For instance, traders might use the ADX in conjunction with moving averages to identify trend reversals. A crossover of the price and a moving average, coupled with a rising ADX, could indicate a potential trading opportunity. It's essential to remember that no trading indicator, including the ADX, is foolproof. Traders should always use the ADX in conjunction with other forms of analysis and manage their risk appropriately. Section 5. Combining ADX with other indicators. While the average directional index, or ADX, is a powerful tool on its own, its effectiveness can be significantly enhanced by combining it with other technical indicators. This synergy allows traders to gain a more comprehensive understanding of market conditions and make more informed trading decisions. One popular combination is using the ADX with moving averages. Moving averages, such as the 20-day or 50-day moving average, help identify the overall trend direction. By pairing this with the ADX, traders can confirm the strength of the trend. For example, if the price is above the 20-day moving average and the ADX is above 25, it suggests a strong uptrend. Another powerful combination is using the ADX with the moving average convergence divergence, or MACD indicator. The MACD is a momentum oscillator that identifies changes in the speed and direction of price movements. Combining the ADX with the MACD can help traders identify strong trends with increasing momentum. For instance, a bullish MACD crossover combined with a rising ADX above 25 could signal a strong buy signal. By combining the ADX with other indicators like moving averages, MACD, or even Bollinger Bands, traders can filter out false signals, confirm trend strength, and identify high-probability trading opportunities. Section 6. Practical example, ADX in action. Let's consider a practical example to illustrate how the ADX can be used in a real-world trading scenario. Suppose a trader is analyzing the chart of a stock and observes that the price has been steadily rising, forming higher highs and higher lows. This suggests an uptrend is in play. To confirm the strength of this uptrend, the trader looks at the ADX indicator. The ADX line is above 25 and rising, indicating a strong trend. Additionally, the plus DI line is above the minus DI line, confirming that buying pressure is dominant. Based on this information, the trader decides to enter a long position, buying the stock with the expectation that the uptrend will continue. To manage risk, the trader sets a stop-loss order below the recent low, limiting potential losses if the trend reverses. As the price continues to rise, the ADX remains above 25, providing confidence in the trade. However, if the ADX starts to decline below 25, it could signal that the uptrend is weakening, prompting the trader to consider exiting the position or tightening their stop-loss order. Section 7. Comparing ADX and RSI. Different tools, different purposes. While both the average directional index, or ADX, and the relative strength index, or RSI, are popular technical indicators, they serve different purposes and provide distinct insights into market behavior. Understanding their differences is crucial for traders to use them effectively. The ADX, as we've discussed, focuses solely on trend strength. It tells you how strong a trend is regardless of its direction. On the other hand, the RSI is a momentum oscillator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. The RSI oscillates between 0 and 100. Readings above 70 are generally considered overbought, suggesting that the asset might be due for a pullback. Conversely, readings below 30 are considered oversold, indicating a potential bounce. Therefore, the ADX and RSI complement each other. The ADX identifies strong trends, while the RSI helps pinpoint potential entry and exit points within those trends. For example, a trader might look for buy signals when the ADX is above 25, indicating a strong trend, and the RSI is below 30, suggesting an oversold condition. Section 8. Advantages of using the ADX indicator. The average directional index, or ADX, offers several advantages for traders, making it a valuable tool in technical analysis. Clear trend identification. The ADX excels at identifying the strength of a trend, regardless of its direction. This helps traders focus on assets with strong momentum, improving the probability of successful trades. Objective measurement. Unlike subjective interpretations of chart patterns, the ADX provides a quantifiable measure of trend strength. This objectivity helps traders make more disciplined decisions. Early trend change detection. The ADX can signal potential trend changes by showing divergence or a decline in strength. This early warning system allows traders to adapt their strategies and potentially exit trades before significant reversals occur. Versatility across markets. The ADX is applicable to various financial markets including stocks, forex, commodities, and indices. This makes it a versatile tool for traders operating in different asset classes. By incorporating the ADX into their trading strategies, traders gain valuable insights into trend strength, potential reversals, and overall market momentum. Section 9. Disadvantages of using the ADX indicator. While the average directional index, or ADX, offers valuable insights, it also has some limitations that traders should be aware of. Lagging indicator. The ADX is a lagging indicator, meaning it follows price action rather than predicting it. As a result, it might not be as effective in rapidly changing markets. False signals. Like any other indicator, the ADX can generate false signals, especially in choppy or sideways markets. Traders should always use the ADX in conjunction with other forms of analysis to confirm signals. Subjectivity in interpretation. While the ADX provides numerical values, interpreting its signals can still involve some subjectivity, particularly when determining entry and exit points. Not ideal for range-bound markets. The ADX is most effective in trending markets. In range-bound markets where prices move sideways, the ADX might generate misleading signals. Despite these limitations, the ADX remains a valuable tool for traders who understand its strengths and weaknesses. By using the ADX in conjunction with other indicators, price action analysis, and risk management techniques, traders can mitigate its drawbacks and leverage its strengths for more informed trading decisions.